Have you encountered a situation where you're stuck between two major business decisions, that is, borrowing money or selling equity to investors? Now, this is exactly the dilemma Riya and Arjun, both founders of growing startups, are facing. Riya is staring at a loan agreement, feeling stressed about the interest payments and long-term burden, while Arjun is deep in discussions with investors about selling more equity, but he's reluctant to give up ownership of his company. Both options come up with their own set of challenges. Riya is worried about the cost of debt, and Arjun is grappling with the cost of equity and the fear of diluting his ownership. They're both asking themselves, what's the smarter choice for business growth? Borrowing money, which is debt, or giving away shares, that is equity. Now, if you're facing the tough decisions too, don't worry, you're not alone. In this video, we will dive into the real cost of both options, break down key concepts like capital structure, cost of debt, and cost of equity, and also explore the strategic differences that could help entrepreneurs like Riya and Arjun make informed, smarter financial decisions. So whether you're dealing with a similar dilemma or just curious about how companies balance these two choices, this video will give you through it and give you all the tools to choose the right path for your business growth. So guys, if you want to see more content like this, do like, share and subscribe to our YouTube channel and hit that like button below. So let's get started. Now before we take a deep dive in, I have a quick quiz for you. Which of the following is an example of a fixed cost? Raw materials, labor cost, rent for office space, or sales commissions? Let me know your answers in the comment section below. Now before we move on, here's a quick information. If you are passionate about advancing your business career and acquiring a globally recognized credential, you are at the right place. Simplilearn, in collaboration with IIM Indore, presents the Executive Certificate Program in General Management, the prestigious program delivered by one of the India's top business schools, offering cutting-edge curriculum focused on the most critical aspect of modern management, including business analytics, AI, and decision making. You'll gain access to high-impact learning experience, including 3-day campus immersion at IIM Indore, and over the course of this 6-month live online interactive program, you will tackle real business problems through a faculty-mentored capstone project, enhancing your leadership of skills and strategic thinking. The program is designed for professionals with 2+ years of experience and is tailored to equip you with the knowledge and skills needed for senior management roles. And upon completion, you will not only earn an executive certificate from IIM Indore, but also you will gain executive education alumni status, unlocking access to exclusive network of leaders. So what are you waiting for? Hurry up and enroll now, and you can find the course link below. Let's get started. So let's understand the capital structure basics. First things first, what capital structure actually means? Now, at its core, capital structure refers to the way a company finances its operations and growth through a mix of debt and equity. Essentially, it's a combination of funds that a company uses to operate, expand, and grow. It's like the financial foundation of your business, built on two primary sources of capital. That is borrowed money, which is debt, and the raised capital, which is equity. Let's take a closer look at each one of them. First one is debt. Now, this is a money a company borrows from an external sources such as bank or bondholders. This borrowed money must be repaid with interest. Examples of debt financing include bank loans, bonds, or lines of credits. Debt can be beneficial because the company maintains full control and ownership, but it comes with a responsibility of paying interest and principal over the time. Let's move on and understand what is equity. This is a money a company raises by selling shares of the business to investors. And in return, investors receive ownership stakes in the company. Unlike debt, equity does not require regular repayments, but it does mean giving up a portion of your company's ownership and control. Now, why is understanding capital structure so important? Well, the way a company mixes debt and equity affects nearly everything about the business, its growth potential, risk profile valuation, and the expectations of investors. To put it simply, the right mix of debt and equity can optimize your company's financial performance and reduce overall risk. And that's where WACC, which means weighted average cost of capital, comes in. WACC stands for weighted average cost of capital. WACC measures the average cost of the company's capital, taking into account both debt and equity. By lowering WACC, a company can become more efficient in its growth strategies, ultimately leading to a higher valuation. So, the way you balance debt and equity directly impacts your company's financial health. Now, let's understand what is the cost of debt. The cost of debt refers to the interest rate a company pays to borrow money from creditors. It's especially the price of using other people's money to grow your business. One of the key benefits of debt financing is that the interest payments are tax deductible, which help to reduce the overall cost of borrowing. Let's take an example. Imagine your company takes out $1 million loan at an interest rate of 10%. On the surface, it may seem like your company is paying 10% to borrow that money, but because interest is tax deductible, the effective cost of debt is lower. I'll give you one more example. Let's suppose if your company is taxed at 30%, the effective interest rate you're paying is actually lower than the stated 10% because you get a tax break on the interest you pay. Let's calculate that. So here, the cost of debt is interest rate into 1 minus tax rate. This is the formula to be followed. So the cost of debt becomes 10%, which is the interest rate, into 1 minus 0.3%, which is the tax rate, which is equals to 7%. So while the nominal interest rate is 10%, the effective cost to the company is only 7% after counting for tax savings. This makes debt a much cheaper form of financing compared to equity, where investors expect higher returns. So let's talk about the cost of equity. Now, when a company raises money by selling shares to investors, it's essentially giving away ownership in exchange for capital. But the key difference between debt and equity is that equity does not require fixed repayments. However, equity investors expect a return for taking on the risk of owning a part of their business. Now, to calculate the cost of equity, we use a formula known as capital asset pricing model. So here the formula for calculating the cost of equity is risk-free rate plus beta into market return minus risk-free rate. The risk-free rate is the return an investor would expect from a completely safe investment such as government bonds. Beta here represents the volatility of the company's stock compared to broader market. The market return is the overall return investors expect from the stock market as a whole. Why this happened? Because equity investors take on more risk than debt holders since they are last in line to be repaid if the company goes bankrupt. They expect a higher return. This makes equity financing more expensive than debt financing in terms of expected returns. Let's have a look at a live calculation example. I'll walk you through a real-life example of calculating both cost of debt and cost of equity. Now imagine a company that has $4 million in debt and it pays $400,000 in interest every year. The company has got 30% of tax rate. Now that we have calculated the cost of debt, let's calculate the cost of equity. Assume the company's beta is 1.2, market return is 12%, and risk-free rate is 4%. So here the cost of equity will become 4% plus 1.2 into 12% minus 4%, which is equals to 13.6%. So here the cost of debt is 7% and cost of equity is 13.6%. We now need to calculate the weighted average cost of capital. Let's say the company has got 50:50 ratio of debt to equity. So we will calculate WACC, which is 0.5 into 7% plus 0.5 into 13.6%, which is equals to 10.3%. Now, by balancing both debt and equity, the company's WACC comes out to 10.3%. Lowering this rate will allow the company to raise capital more efficiently, leading to higher valuation and more growth potential. Now let's break down the key differences between debt and equity. Focusing on risk, control, cost, and repayment obligations, each option has its pros and cons, and the right mix will depend on your company's goal. First, we look at the risk feature for debt, which is lower predictable payments. And for equity, it's higher and its returns depend on company's performance. Then we've got the cost feature for debt, which is lower. Interest is tax deductible. Whereas in the case of equity, it's higher because investors expect higher returns. Then we've got repayment feature. Now in the case of debt, it's mandatory and it must be paid back regardless. Whereas in case of equity, it's none. No obligation to repay to investors. Talking about ownership, debt is retained. That is no dilution of ownership. Whereas in the case of equity, it's diluted. Ownership is shared with investors. Then we've got bankruptcy risk. In the case of debt, it's higher risk if payments are missed. Whereas in the case of equity, it has got lower risk and equity holders are last in line. Let's look at the ranking myth and realities. There are many misconceptions about debt and equity. Let's clear them up. The first one is debt is always the best option. This is only true for mature companies that have a steady stream of revenue and can manage debt repayments. Startups or companies with unstable cash flow should avoid too much of debt. The second one is equity weakens a company. Not true, in fact. Startups often need equity to fuel growth without worrying about fixed repayments. The third one is WACC keeps falling with more debt. Adding more debt can initially lower the WACC, but eventually too much debt increases the company's risk, causing leaders to demand higher interest rates, which in turn increases the WACC. Now we'll have a look at case studies and see how decision works in action. So we'll be looking at two real-world companies, which is Apple and Airbnb. Talking about Apple, now Apple is a mature, profitable company, choose to issue bonds rather than sell more stock. This decision was driven by low interest rates and it allowed Apple to raise capital without giving up ownership. On the other hand, startups like Airbnb raised equity capital in their early stages because debt wasn't an option due to volatility in their revenue. They needed flexibility and growth capital, and equity provided that without the fixed repayment schedule of debt. Now, how do you make the right decision for your business? Don't worry, here's a simple checklist which will help you decide. Stable cash flow and a strong credit history. Favor debt, it's cheaper. The second one is unpredictable market or early stage company. Lean towards equity, it's safer. Third one is optimal blend. Mix debt and equity to minimize WACC and maximize growth. So what would you choose for your business? Would you take on debt or would you sell some shares and bring in equity investors? Drop your answer in the comment section below. So guys, that's a wrap. Don't forget to like, share and subscribe for more such insights on business strategy, financial decision making and corporate growth. If you have any doubts or questions, ask them in the comment section below. Our team of experts will reply you as soon as possible. Thank you and keep learning with Simplilearn. Hi there, if you like this video, subscribe to Simplilearn YouTube channel and click here to watch similar videos. To nerd up and get certified, you can check the description box below.